A company built on open-source software that anyone can use for free, is reportedly approaching a $4.8 billion revenue run rate, with strong year-over-year growth. The company has also indicated it is free cash flow positive. So how do you build a money machine out of something you give away? And the decision they made in 2020, when their biggest rival was dominating the market and many analysts believed Databricks was falling behind, was seen by some as risky. It ultimately proved to be a significant strategic move in modern data infrastructure. This is Moat and Margin. Databricks generates revenue by offering a managed cloud platform for data engineering, analytics, and AI. Companies pay based on their compute consumption. The more data they process, the more they pay. This consumption-based model means revenue can scale with customer usage. Industry reports suggest gross margins are in the 75 to 80% range, which is notable for infrastructure software. The core engine, Apache Spark, is open source. Databricks did not build a proprietary black box, but rather developed the managed experience around it. But this almost never happened. Databricks was founded in 2013 out of UC Berkeley's AMP Lab by 7 academics, including Ali Ghodsi. They created Apache Spark, a data processing framework. The challenge was that enterprises were initially hesitant to buy software from an academic team. Their first product did not gain traction. Enterprise sales were difficult, and early funding was used up trying to sell a solution that CIOs were not yet ready for. The company nearly failed before it began. Ghodsi made a pivotal decision. Instead of licensing Spark, they would build a cloud-native platform on top of it. That pivot changed the company's trajectory. Rather than competing with free open-source tools, they built on top of them. Enterprises could leverage Spark's power without the complexity of managing it. By 2019, Databricks reportedly surpassed $200 million in annual recurring revenue. But challenges remained. Snowflake went public in September 2020 at a $33 billion valuation, at the time one of the largest software IPOs in history. This event shifted perceptions in the data infrastructure market, with Snowflake seen as a leading player. While Snowflake was celebrating its IPO, Databricks introduced the Lakehouse architecture, a system that merged data warehouses and data lakes into a single platform. This approach was distinctive at scale. The trade-off was significant. Enterprises were asked to rethink their data stack. However, the value proposition was compelling. One system instead of two. The Lakehouse unified analytical and AI workloads, encouraging customers to use Databricks as a central platform. Retention metrics are notable. Reports indicate Databricks maintains a net revenue retention rate above 140%, meaning existing customers increase their spending year over year. This reflects strong customer engagement. For platform businesses, this is instructive. Competing on architecture rather than features can create defensible advantages. Databricks did not simply add features, they redefined a category boundary. Key move 2, acquiring MosaicML in 2023 for a reported $1.3 billion. MosaicML enabled companies to train large language models efficiently. This acquisition expanded Databricks' capabilities in the AI training space. This mattered because companies seeking to build custom AI models could now do so within Databricks. Data storage, analytics, and model training could all occur on one platform, increasing switching costs for customers. However, Databricks' growth was not without challenges. Between 2021 and 2023, the company faced significant cash outflows. The company invested heavily in R&D and sales. The MosaicML acquisition was a major expenditure. Meanwhile, Snowflake was profitable and public, promoting the data warehouse model. Some analysts questioned whether Databricks' broad approach would succeed. Major cloud providers, AWS, Google, and Microsoft, also offered competing data platforms and controlled the infrastructure Databricks relied on. This created additional competitive pressures. The next strategic move was the AI pivot. When generative AI gained momentum in late 2022, many data companies quickly added AI features. Databricks, however, had been developing for this shift over several years. With MosaicML integrated, Databricks launched model training, fine-tuning, and serving within its platform. The company released open-source models such as DBRX, aiming to provide alternatives to proprietary solutions. The message: keep your data in your own environment and train your own models. For founders considering open source versus proprietary AI, Databricks' approach demonstrates that open source can drive adoption, while a managed platform can generate revenue, provided the experience layer is controlled. Key move 4. Achieving free cash flow positivity. In late 2024, Databricks announced it had been free cash flow positive for over 12 consecutive months. This milestone signaled to investors and the market that the business model could scale sustainably. The rivalry with Snowflake continued. Snowflake appointed a new CEO, introduced AI features, and expanded into machine learning workloads. The data infrastructure market became increasingly competitive. Snowflake's strength was simplicity and ease of adoption, especially for SQL-based analytics. Databricks' strength was its depth in engineering, science, and AI workloads. The market began to reflect these differences in performance metrics. A key moment was the December 2024 funding round. Databricks reportedly raised $10 billion at a $62 billion valuation, led by Thrive Capital. Reports suggest the majority of this round was equity. This scale of funding is rare for a private company and indicates strong investor confidence ahead of a potential IPO. With a multi-billion-dollar revenue run rate, strong growth, positive cash flow, and a large enterprise customer base, Databricks is widely regarded as a leading candidate for a major tech IPO. The company may help define how public markets value AI infrastructure businesses in the coming years. 3 lessons from the Databricks playbook. First, creating a new category can be more effective than competing within an established one. Second, embedding deeply into customer workflows can create defensible moats, especially when operating on third-party infrastructure. Third, a consumption-based revenue model can drive growth as customer data volumes increase. Databricks' journey from a university research project to a highly anticipated tech IPO candidate illustrates the power of combining open-source innovation with a managed platform business model. Subscribe to Moat and Margin for more insights on platform businesses and IPO strategies.